Happened last week that defied every rule in the financial textbook. Oil prices hit levels we haven't seen in years. Analysts at Goldman Sachs are, with a straight face, projecting $200 a barrel. Meanwhile, gold, the so-called safe haven, the asset that's supposed to surge when the world is in crisis, just posted its single worst week in 43 years. Worse than the week of September 11th. Worse than the 2008 financial collapse. Worse than the moment Russia invaded Ukraine. War breaks out, oil spikes, and gold crashes. If that contradiction doesn't make sense to you yet, it will. And once it does, you'll never look at a market headline the same way again. I'm an economist and former investment banker, and over the next 10 minutes, I'm going to walk you through three things. 1. Exactly why gold is defying the textbook right now. 2. The chain reaction that runs from oil prices directly into your portfolio. And 3. How to position yourself. Not by panicking, not by gambling on headlines, but by understanding the mechanics. Because in markets, it's never the headline that matters. It's always the chain reaction behind it. 2. The geography of crisis, visual animated map, zoom into Persian Gulf, highlight Strait of Hormuz. To understand any of this, we have to start with geography, specifically a stretch of water that most people couldn't find on a map, but that controls the flow of energy for the entire global economy. The Strait of Hormuz. Every single day, 20 million barrels of oil pass through this corridor. That's 20% of all seaborne oil on the planet, moving through a channel just 20 miles wide at its narrowest point. And Iran sits directly on top of it. Pause. Here's what most commentators miss. Iran doesn't need to win a war to cripple the global economy. They don't even need to fire a missile. They simply need to make that strait feel dangerous. The moment that happens, major insurers refuse to cover oil tankers in the region. Shipping companies can't operate uninsured vessels. The tankers stop, the oil flow slows, and markets, which are always forward-looking, begin pricing in the risk before a single barrel is blocked. Markets don't wait for outcomes. They price in probabilities. We've seen this exact pattern before. 1979. The Iranian Revolution caused oil to double. 1990, the Gulf War triggered another doubling. 2022, Russia invades Ukraine. Brent crude hits $100 to $39 in a week. Goldman Sachs says $200 oil is not a tail risk. It is a serious base case scenario. Asian economies are already paying north of $150 a barrel today. So the oil story makes sense. But why is gold falling? The chain reaction. To understand gold's behavior, you need to understand that oil is not just fuel. It is the foundational input cost of the entire modern economy. Oil is embedded in transportation, manufacturing, food production, fertilizers, pharmaceuticals, plastics, and electricity. When oil rises, the cost of producing and delivering almost everything rises with it. Here is the chain reaction. Higher oil leads to higher inflation. Higher inflation leads to the Fed has no reason to cut interest rates. Higher rates lead to borrowing becoming more expensive, profit margins compressing, and stock prices falling. But here's the link most retail investors miss entirely. Higher interest rates also strengthen the US dollar, and a stronger dollar makes gold, which is priced in dollars, more expensive for every buyer outside the United States. So when institutions see dollar strength accelerating, they sell gold. Not because they've lost faith in it, but because the short-term math no longer works in their favor. And then leverage amplifies everything. A 2% drop in spot gold becomes a 6% loss in a 3 times leveraged ETF. That triggers margin calls. Fund managers are forced to sell, not because they want to, but because their brokers require it. Forced selling drives the price lower, which triggers more margin calls, which drives the price lower still. This is not a mystery. It is mechanics. And understanding the mechanics is what separates investors who profit from those who panic. Section 4. Who is actually selling? Visual institutional flow. Graphic, arrows from London vaults, Turkey Central Bank. 2 actors are driving the most significant gold selling right now. And neither is a retail investor making an emotional decision. First, Turkey's central bank panic sold 58 metric tons of gold in just 2 weeks. Turkey is facing a currency crisis and converting gold reserves to dollars to defend the lira. Second, Gulf sovereign wealth funds, Saudi Arabia, the UAE, Qatar, are quietly liquidating bullion held in London vaults. At $200 oil, their hydrocarbon revenues are extraordinary. They don't need a hedge against economic instability. They are the beneficiaries of it. The mainstream media told you gold fell because inflation data came in hot. That's technically true. But it's like explaining a car crash by saying the car stopped moving because there was a tree in the way. Accurate and almost entirely useless. The real question is never what happened. It's always why and what comes next. How to position your portfolio. Every crisis creates winners and losers. The difference between the two is almost never luck. It is preparation. What is performing well right now? Energy companies are the most direct beneficiaries. Their revenues rise in near linear proportion to oil prices. Pipeline and infrastructure companies offer a more defensive way in. Their revenues are toll-based. They earn fees on volume, not price, which provides stability while still benefiting from increased energy activity. Companies with genuine pricing power, businesses that can pass higher input costs to customers without losing market share, are arguably the most valuable businesses to own in an inflationary environment. Defense contractors require careful analysis. Select companies with confirmed government backlogs are worth examining, but procurement cycles are long and contract awards are unpredictable. What is under pressure? Airlines. Jet fuel is a major operating cost and fare hikes have limits. Retailers with thin margins and high transportation dependencies get squeezed on every side. Banks and utilities, both heavily rate sensitive, face headwinds as long as the Fed stays on hold. Your action checklist. 5 questions to ask about your portfolio this week. 1. What is your current energy exposure? Zero allocation means you're fully exposed to the inflationary drag of higher oil with no offsetting gains. 2. Which of your holdings are rate sensitive? REITs, utilities, long-duration bonds, and high-multiple growth stocks all face pressure when rates stay elevated. 3. Do you have any infrastructure exposure? Pipelines have historically provided inflation protection with lower volatility than commodity producers. 4. If you're considering defense, are you looking at companies with confirmed backlogs? Not just thematic exposure to geopolitical headlines? 5. Can the companies you own raise prices? In an inflationary environment, pricing power is worth more than almost any other fundamental characteristic. Gold's long-term picture. A final word on gold part. Because I don't want to leave you with the impression that this week's performance changes the long-term thesis. What we witnessed was a short-term mechanical repricing driven by institutional liquidation, dollar strength, and leverage unwinding. That is not the same as a fundamental rejection of gold as a store of value. Historically, gold has shown its most powerful performance not during the initial shock, but in the months that follow, once the dollar stabilizes and inflation expectations become more entrenched. If you're a long-term investor, the current weakness may ultimately present an entry point rather than a warning sign. That said, timing is everything and ultimately can encompass a great deal of pain in the interim. The investors who get hurt in environments like this are not the ones who made the wrong calls. They're the ones who didn't understand why things were moving, and so had no framework for what to do next. Managing money is a skill. Like any skill, it can be learned, and the people who take the time to learn it properly have a significant durable edge over those who don't. Every crisis creates opportunity, but only for those who understand the mechanics well enough to see it. If you want to go deeper on the frameworks we covered today, the chain reaction model, energy portfolio construction, and how institutional investors think about geopolitical risk, you've reached the right platform to gain a clear understanding of the current situation. Subscribe for more educational and well-researched insights.